Hello student, today we are going to start our third book, that is Financial Statement Analysis, and in this video we are going to start our first chapter, that is Financial Statement of the Company, class 12th Accountancy. Okay, so what is the financial statement? Financial statement provide the various information of the shareholders and external parties like creditor, investors, bankers, etc. about the profitability of the company, right? Financial statement have four parts. First part is balance sheet, second is profit and loss account, third is notes to account, and fourth is cash flow statement. So in a particular video, we are going to discuss the content of balance sheet because it is the root of this book. You have to understand what is balance sheet, what is content of balance sheet, so that in future you have benefit to solve the question. It will help you to solve question in a significant manner, right? Okay, so let's start. What is characteristics, format and content of balance sheet? Balance sheet is also called position statement. Okay, it is also called position statement because it shows the financial position of the company. It includes assets, equity, liabilities at a particular date. What is equity? A liabilities towards shareholders is termed as equity or shareholders fund. You have already studied in class 11 that company has different entity under the different entity concept, company's entities concept, like company and the shareholders are two different persons. So whatever money is invested by shareholders is termed as a liability of the company, right? What is liability? Liability is those obligations which we have to pay to outsiders in future, right? It is divided into two parts, non-current and current liabilities. Okay. What is the characteristics of balance sheet? First, it includes assets, liability and owner's equity. It consists opening balance transaction during the year and closing balance of the company. It satisfies the accounting equation like assets is equal to liabilities plus owner's equity or capital. You have studied in class 11. This is based on dual aspect concept. What is dual aspect concept? It states that whatever transaction is going on, it have two aspects. One is debited and another is credited. And last, it gives the true picture of financial position of the company. Okay, now the format of balance sheet is totally changed. It is based on vertical balance sheet. That horizontal balance sheet is not applicable by the Companies Act 2013, right? So now we are going to discuss the format of balance sheet. First of all, balance sheet have equity and liability. First heading, which includes shareholders fund. What is shareholders fund? Shareholders fund are those fund which is invested by the owner of the company. It includes two types of shares like preference shares and equity share. What is preference share? These are those shares which enjoys the preferential right. And what is equity share? These are those shares which do not have any preferential right but enjoys the voting right. Okay. Second is reserves and surplus. Company maintain different types of reserves and surplus for the future, and these reserves and surplus are treated as a liability of the company because whatever reserves and surplus are maintained is maintained by out of profit, and the profit of the company arises by the investment of shareholders, by the investment of share capital, and shareholders are owner of the company but their capital is treated as a liability. So if we save some profit from the benefits of shareholding or benefits which is invested by the shareholders, so it is also termed as a liability. And third is money received against share warrant. What is share warrant? Share warrants are those shares which is issued for the temporary period, which is issued by the company for the temporary period for the temporary capital. Okay. Share application money pending allotment. Sometimes company issue shares and they receive money, but at the end of accounting period they are unable to allot the shares to that person who subscribed the share. So that money is also treated as a liability. Non-current liabilities, these are those liability which we don't have to pay in current operating cycle, okay, and current liability are those liability which we have to pay in the current operating cycle, okay. Now second head is assets, which include two headings like non-current assets and current assets, okay. Non-current assets are those assets which are we can say that which are not have to pay or which we don't receive in current period, which we receive in another operating cycle, okay, which include tangible assets, intangible assets, capital work in progress and intangible assets under development, okay. Non-current investment, deferred tax assets, long-term loans and advances and other non-current asset. All the items we discuss in video. Current assets include current investment, inventory, that is stock, trade receivable, bill receivable you studied in class 11, cash and cash equivalent, short-term loans which we lend to some other person, and current assets, okay. So now we discuss the content of balance sheet. First of all, we discuss the shareholders fund. This heading of the company of 3 or more items which are follows. Share capital. Share capital are those capital which is issued by the company for the subscription and received in the money or cash for the consideration other than cash, okay. This is shares which company issue in the market for the subscription, and it may be in cash or other than cash, consider as a cash, okay. Now the format of the company is totally changed by Schedule 3rd of the Companies Act 2013. We can divide the share capital in these parts. First is authorized capital. It is a nominal capital which is included in capital clause of the company, and it is a maximum capital that company can issue for the subscription, okay. Issued capital are those capital which is issued by the company for the subscription in the market. What is subscribed capital? These are those capital which is purchased by any person, any company or any institution. It may be fully paid up, not fully paid up, or calls in arrear and forfeited share. Fully paid up, like when the face value of the share, like if the face value of the share is 10 rupees and you receive 10 rupees, then it is called fully paid up share, okay. Then it is called fully paid up share, right, okay. Second is not fully paid up, when the full amount of the company or full face value of the share is not received, then it is called subscribed but not fully paid up. Calls in arrear, the amount not received by the company against the amount called up, then it is called calls in arrear. And amount forfeited, when a person is failed to pay the amount called up, whatever money called by the company for the share capital, then company has right to forfeit or to snatch back the shares, and this is called forfeited share. Now, what is reserves and surplus? When a company receive a profit, all the profit is not distributed by the company. They save some profit for the future, and this is called reserves and surpluses, okay. Profit set aside out of profit, and surpluses are not distributed to the shareholders, which can then use for any future uncertainties, right. It includes capital reserve. It is that reserve which is maintained by the capital gain. Like if you sell a land and you receive a good amount, you can save as a capital reserve. Capital redemption reserve, This reserve is created at the time when the company purchases its own shares out of free reserves of the security premium reserve. Okay, what is security premium reserve? These are those reserves which is created with the amount of receipt in excess of nominal or face value of security issued. Like if the face value of the share is 10 and you receive 12 rupees, then 2 rupees treated as a security premium reserve. Okay, it is treated as a security premium, right? Debenture redemption reserve, these are those reserve which is maintained by the company for the redemption of debentures. Revaluation reserve, these are those reserve which is created by upward revision of the book value of an assets and debited with the downward revision of the book of the value of assets. Like if you purchase a land for 1 lakh, and after 3 years it become 3 lakh, its value become 3 lakh, then 2 lakh will be increased and it is included in revaluation reserve. This value, this profit is included in revaluation reserve, right? Share option outstanding account, it is a reserve which is credited with the amount of difference between market value of the share issued to the employee and its issued price over the vesting period. Other reserve, it is the reserve which is of such nature and purpose which is not specified under any heads of above. And surpluses are those profit which we gain in profit and loss account, which we estimated in profit and loss account, gross profit, net profit in a particular period, right? Okay, money received against share warrant, this is deleted from your syllabus, so we don't have to discuss this. Because this is not come in your examination, CBSE has deleted this topic. Second is share application money pending allotment. It shows the amount received by the company towards the share application against which it is certainly allotted share. Like if we receive the money from the person but still we have not allotted the share, that will be included in application money pending allotment. We have not allotted any share and it is pending. Okay? Okay. Share application money to be treated as a current liability when we have to allot the share in the current operating cycle. Non-current liabilities, these are those liabilities which is included in Schedule 3rd of Companies Act 2013, which is not current, which we don't have to pay in current operating cycle. Operating cycle, we already have discussed that when you invest a raw material and the time period it takes to convert in cash, that time period is treated as a operating cycle. Okay? Long-term borrowing are those borrowing which is not payable within the 12 month of the balance sheet date, and it includes so many things like bonds, long-term loans, public deposit and etc. Deferred tax liability, when a company have to pay their tax in advance in the starting of the operating cycle, in the starting of accounting period. So they pay their tax on the basis of estimated profit. They estimate their profit, they make their average profit, and on the basis of that profit they pay their tax. If estimated profit is smaller than actual profit, then company has to pay more tax, and this tax is called deferred tax liability. Okay? Right? Deferred tax is the amount of tax that is calculated on the amount of difference being temporary in nature between the accounting income and taxable income, okay, in a particular year. If the accounting income is more than the taxable income, it results in deferred tax liability, because we have to pay in the future, we have to pay more tax in the future. Okay? Other long-term liabilities, it include trade payables, okay, which we don't have to pay in same operating cycle, and other like long-term liability which is left in the above heads are included in this. Long-term provisions, these are those provisions which we has kept in a particular amount for the future liabilities, that is called long-term provision. Okay? After 12 months, we have to pay that amount or in a different operating cycle, so it is termed as a long-term provision. Current liabilities include those liabilities which we have to pay in current operating cycle or within the 12 month, or being trade payables, it is included in current liabilities, right? Current liabilities include short-term borrowings. You know what is short-term borrowings, which have maturity period in between 12 months or in a current operating cycle. Trade payables, which we have to pay money to our creditor in the current operating cycle, and other current liabilities, whatever is left in above section, it's included in this. Okay? Short-term provisions, we make some short-term provisions like liabilities, short-term bad debt provisions, that is included in short-term provision, right? Now we have to discuss the content under the asset part. Non-current assets, these are those assets which are not current in nature. These assets which are not current assets, it include the major heads. Fixed assets, these are assets which are not held by the company for the purpose of trade or resale. Okay, whatever assets company hold but don't have to pay or don't have any intention to resale, then it is called fixed asset. Like in an institution, table, chairs, land, building are not for resale. Okay, so it is a fixed asset. Fixed asset can be divided in two parts, tangible and intangible. Tangible assets are those assets which we can see, touch and have a physical existence, and intangible assets are those assets which we cannot see, touch and don't have any physical existence, but it gives certain benefits like patent and copyrights. Okay? Capital work in progress, these are tangible assets which are under the construction, and intangible assets under the development, these are those intangible assets which are still in progress. Okay? Second is non-current investment. These are those investment which not held by the business for the purpose of trade or resale. Instead, they are retained for a longer time period to earn income. Okay? Deferred tax asset, as deferred tax liability, it is a deferred tax assets. Deferred tax is the amount of tax that is calculated on the amount of difference being temporary in nature between the accounting income and taxable income. Okay? Like when accounting income is less than taxable income, it means we have paid more tax than actual tax. So that tax will be refunded by income tax department and it is treated as a deferred tax assets. It is also deleted from the syllabus. It is not coming to your examination, but you have to understand what it is. Okay? Long-term advances which we have paid to some other person, which company lend to some other person and some another institution, that is long-term advances. Capital advances, security deposits, etc. Okay? Non-current assets, it include non-current asset other than the specified classified. Whatever left from above heads is included in this. Okay? Current assets, as per Schedule of Companies Act 2013, current assets is one that satisfy any of the following condition. What is the following condition? It relies or intend to sell or consume within the company's operating cycle, to be realized in 12 months, okay, after the reporting date, held for the purpose of retrade or resale, cash and cash equivalent. Okay, so these are the current asset. It include current investment, which is going to mature it within the 12 month or in a operating cycle. Inventory, as we know, we use inventory for the purpose of resale, then it is current assets. And trade receivable, which is we have to receive in same operating cycle or in a 12 month, in between 12 months, so it is trade receivable. Okay, it includes cash and cash equivalents. Okay, short term loans and advances which the company lends to some other person and expected to be realized within the 12 months, and other current assets. Okay, what is contingent liability? These are liability which may or may not arise depend upon happening or non-happening of event in the future. Such amount is not recorded in book of account, therefore it is required to disclose in the notes to the account. Okay, when we prepare a balance sheet, we have to prepare notes to account in order to inform the user about the financial statement. Okay, and commitments, these are the financial commitment due to the activity agreed by the company to be undertaken in future. Okay, it is also included in this. These two items, contingent liability and commitments, are shown in the notes to account. So this is the introduction of balance sheet. All the content of balance sheet and the heads of balance sheet you must remember for preparation of balance sheet. In next video, we try to solve some questions from your book which is based on balance sheet and operating cycle. Okay, thank you.